let's get into the fundamentals. Matt, so starts and deliveries. Supply has been the story for multifamily for the last several years. 50-year peak in new deliveries, get us up to speed, kind of where we are with supply, but then starts. What are we actually building now in the future?
Yeah. So supply is still elevated as this new wave of apartment deliveries recedes, but starts have declined, and new deliveries are projected to decline sharply as well, really by a considerable amount. So we're talking like half, basically cut things in half. Right now, starts are at 59,000, and at their peak, they were 147,000. So that's more than double, really. And the same thing for completions. Right now, during the peak, the completions were 192,000 in Q2 of last year, and then the projections. Again, like we're basically separating by 2.5 years from start to completion. So starts went down. Now we're at a low point in starts, and then in Q2 or Q3 of 2026, we will get 62,000 completions. That is well under the 192,000.
62,000.
Yeah, that's in a quarter.
Okay,
and that's well under the quarterly record of 196,000.
Yeah, either way.
Yeah.
That's incredible. So, I mean, really what we're looking at, and it's hard to stay up to speed because when you're living in a world where we have a glut of new supply, to imagine a world of where we have a scarcity is a little bit challenging. But it's not too far ago. We have to remind ourselves where we have had and still have a housing crisis. We still haven't built enough housing units.
We've
just been delivering a huge concentration of new housing in many select markets. The bulk of these deliveries are all going into the Sun Belt. Not that there aren't major supply waves across most markets, but most markets, especially in the Midwest, Northeast, even the mountain states, are relatively balanced relative to the Sun Belt. But when we crest over the hill, we just don't see any deliveries coming. So we understand that we've been in a high supply environment, and we have a great deal of confidence that there will be less supply coming online over the next several years. And then coming back to tariffs and costs, I can't imagine a world in which steel, aluminum, lumber are being tariffed of 25% or more, that it gets cheaper to build. Labor's not getting any cheaper. Wages have been outpacing rent growth now for the past couple of years. Wage growth has been strong. So labor, materials are all more expensive. It's going to cost more money to build these communities. That means fewer will be built, especially if we still have any degree of uncertainty.
Yeah, we were talking about a barrier, interest rates being a significant barrier, and that is what has been the barrier to multifamily starts in the past couple of years. Even if the interest rates come down this year, the new barrier could be increased labor, increased materials costs.
The costs are still going to go up.
Yeah.
All right. Now, we've talked about supply. On the demand side, this is, to us, I think, has been the more surprising story because we saw the supply coming. We saw the starts earlier. But, Matt, tell us about the demand story. I mean, like, it looks like this is a very positive. I mean, this is like a year-by-year chart, so it's pretty well zoomed out over the last 2 decades. But
unfortunately, we don't have the specific numbers for before 2000 multifamily absorption.
Well, I'm more curious in like quarter by quarter over the last.
Well, quarter by quarter. That's the really promising thing in the shorter term, I guess. So second highest absorption in over 25 years. That's what I was getting to.
Yeah.
But the building to it has also been notable too. In 2022, we had a little bit under 150,000 units absorbed in the entire year. That's very low. And then it went up to a little bit under 350,000, so more than doubled in the next year. And then in the year after that, it's now at 546,000 in absorption. Again, the next highest beyond this, so second highest in over 25 years. The highest was 703,000 units of absorption in 2021, and the there's a big fall off between number 2 and number 3 either. It's hard to describe without it's hard to describe the stellar absorption that we had in 2024 by saying it's in second place, but second place is pretty good in this case. You're really exceeding anything that you see in this chart, anything you see before the pandemic. And it also actually I wanted to note this too when we were talking about supply and demand trends. So let's say usually 400,000 is as many new apartments that usually come in every year. At 70,000, which was the projected low point, we're still well off that 400,000. But I bet that what we really need is something more like 500,000 new apartments built because of the growing household growth, the growing
population
absorption and just natural trends that we'll see here in just a second. We are maybe in a world where we just need a little bit more apartments, and as you noted too, we are still in this deficit of housing that some of the numbers in this report will bear out as well.
Yeah. Well, and also want to look at unemployment rate, household estimates as some of the, again, just additional factors that are going to continue to drive absorption and demand in multifamily. Yeah,
that's exactly what I was thinking of right now. Is this difference between how much households have grown and how much unemployment has been stable. So when you're talking about households, they've grown considerably. And I was measuring actually the growth of actual households versus the growth of housing units.
Yeah.
And households have grown. Housing units have actually that rate of growth has gone down. So we are not building enough units. Period. But when you're talking about labor, the labor market surprisingly is fairly healthy. It's actually very healthy. It's at 4.1. Remarkably stable, well under the 5% unemployment rate considered as to be full employment, and the home buying market is, on the other hand, has just increased a lot. The price for homes has been just the biggest barrier for people, and it's starting it's kind of reviving or really lighting a fire under the narrative of people choosing not to buy and maybe remaining renters. I think it's never been more persuasive now. The relative financial advantage of renting versus owning homes. Just to give a couple numbers here, the costs for home buyers have gone up from 6.98 times annual income to 7.28 times annual income. And when you add in the mortgage rates, those costs of home ownership go up even more. So not only are values of homes going up, from that same period, which is like around 2002 to now, interest rates have definitely gone up. So
yeah, I mean, just like we're showing a chart right here, Matt, showing the cost of ownership compared to renting. And again, renters would tell us, what are you talking about? Rent has gone up, and it has. But when you look at the kind of the parabolic nature of the cost of home ownership, there's really no comparison. And you're right. Before this all happened, we already had individuals that were just preferring renting from a variety of just lifestyle reasons. But now it's become less of a lifestyle choice and more of just you just can't afford to own a home. And then. But then looking at renting, again, talking about it's not just more affordable relative to owning a home. That doesn't mean the renting is still unaffordable. That's not the case. In fact, that home price or rent to income ratios, looking at, considering 30% of one's take home pay being spent on housing, and anything more than that is considered housing burdened. Those rent to income ratios have actually been coming down because rents have been flat or negative in most markets, while wages, because unemployment has been so low, have come up and have increased. I think it's worth noting, Matt, that based on the last section, if we have a recession, we could see a reversal in the low unemployment. We could see a spike in unemployment. Our base case is, though, depending on if a recession happens, it's most likely going to be a relatively mild recession. We could see some impedance to further rent growth and wage growth for a period of time. But again, our base case is it's going to be much more technical much milder, and the overwhelming, inelasticity of apartments and rental demand, and the fact that you need to live somewhere is going to continue to buoy multifamily growth and stability over the long term. Not that in the near term, as we're talking about, there couldn't be some disruptions and bumps in the road. But our whole premise and thesis here is you're going to be able to acquire assets at a value where you can be compensated for that risk of buying in a recession.
And assets that you can be confident that they will perform past this current environment of uncertainty.
Exactly. 100%.
Yeah. Just to also give some numbers about that rent to income, they did go down from 27.7 in 2022 to 25.7 now, which is a relatively big move for that metric. Usually, 2 or 3 percentage points is fairly notable. And again, amidst this environment, where a lot of people are talking about how rents are high, that's a constant narrative, but the evidence shows, and especially amid this housing shortage, that income levels have surpassed. That there's a little bit of a cushion for the apartment market.
Yeah, I agree. Let's talk about investment activity, investment sales, because it's been a slow market right now, man. I can tell you, as someone who's looking to try to, we're always in the market. We have challenges. Again, prices are too high, interest rates are too high at the same time, but transaction activity has picked up. People need to sell. There's funds that are coming at the end of their lifeline. They need to dispose of assets. Got owners that have been in a property they were trying to sell 2 years ago. They haven't been able to do it. They're getting impatient.
Yeah, I think pent-up demand is still really
a lot of pent-up,
really impaired. Yeah,
and pent-up demand on either side. I'd say pent-up demand to sell assets as well as acquire assets.
Yeah.
The question is, in a potential recessionary environment, how many buyers will still be in the market to buy? But let's just talk about what we know from the last couple of years up until today. What does sales activity look like, and what could that tell us about the future?
So for the last part that we have full data for last quarter, it was $35 billion in sales activity. Now that is an improvement, and it has improved for 4 straight quarters since the low point of $17 billion in Q1 of last year. However, all of those numbers are well under the $115 billion sales peak that was in 2021. So that peak, it was 2022, but that sales peak quickly shot down, and in 2023 the sales picked up slightly, but then they came back down again. In 2024, every successive quarter has been improving sales numbers. So we are not anywhere close to what would probably be considered normal amount of multifamily sales activity, but I think it's promising, and to show 4 straight quarters of sales activity growth, sales volume growth is, I think it's really encouraging.
To me, this shows just as we were talking about, the pent-up demand on either side.
And then also, just a couple points that you noted too. Apollo's recent $1.5 billion acquisition of Bridge Investments, and there was late last year Brookfield's recent $845 million acquisition of multifamily assets from Blackstone. There are big institutions that are transacting, and that they're kind of setting prices, and they're setting prices at cap rates that are a little bit lower than you might imagine. But I think that may be par for the course for these big acquisitions.
In many cases it is, but it is still making a market, and we're having some price discovery, which that was the largest challenge for so long, and it's still a challenge today of just there hasn't been enough price discovery, because sellers are saying, well, no, my asset's worth this, because that's where prices were selling the comps that I'm looking back at 2022. But that was peak sales activity, and that was peak ZIRP, and we can't use those as really effective comps for transactions today.
And I think that is an incredibly stark difference between now and 2023 and 2024. People are now realizing how far away 2022 was, and how far away those high prices are. And you were talking about pent-up demand to buy and to sell, and I wonder, and I think we'll be getting to this in just a moment. There will be sellers that are forced to sell. There will be sellers that have to sell. They don't have a choice, and I wonder what impact that's going to have on the market.
Yeah, exactly. All right. So let's go to just summing this section up. I mean, low supply, 2025, end of 2025 onward. I mean, that's something that we can say for certain. I mean, if every developer started putting a shovel in the ground today, we'd see a pickup, but we have a pretty clear idea, at least over the next several years, we're going to be in a lower supply environment. All along the same time, demand is incredibly healthy. Strong demand is anchored by household formation and rent versus buy dynamics. We just have well anchored fundamentals. And then there's strong institutional investment demand. And Matt, as you just laid out, and generally one of the reasons for that is that multifamily, real estate in general, are recession resilient real assets. They can have a proven track record to perform well and sometimes even outperform during a recession. I mean, every recession is different, right? The 2008 recession is going to be a lot different from the recession that happened in 2020 during the pandemic. Yep. During the 2020 pandemic, I mean, multifamily crushed it. I mean, the next couple of years, we had the best couple of years ever, multifamily.
Yep.
And then now we're in this situation where we are. That was an insane cycle. That's most likely not going to be the next case. But
it did demonstrate how a lot of investors were willing to invest at a point where job growth was really low, but they saw those low interest rates, and they had faith in the long-term prospects of the multifamily market, and then they really moved in that, and they kind of enjoyed the rent growth there going forward.
Agreed.